Hello, everyone, and welcome to our K-1 Pass-Through Entity Series. I'm Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. I'm joined here with Linda Keith, our company's founder and Chief Credit Training Officer.
Hello.
Hi, Linda.
Hi.
Today's session slightly different from questions from our participants, but a topic that we're going to talk about, and it has to do with our 6Ns approach to training. We're actually going to cover the first half of those in the global cash flow analysis. 3 of how you can get from taxable income to historical cash flow. Now, some of you may not have heard the 6Ns, as I mentioned before, but it's a model that we use here at Lenders Online Training. We use terms like quack like a duck as well. So we love those fun ways of sharing our learning and helping people train. So Linda, let's get started.
So even though this is a K-1 to pass-through series, on this topic of the ends, and particularly the 3 that get us from taxable income to historical cash flow, I'm going to give the 1040 examples first because I think people are more familiar with those, and then we'll see which ones of those are still in play in the pass-throughs. And as David mentioned, this 6Ns idea, it is one of the training tools that our training has. We use instructional designers and all kinds of understanding of how adults learn best and how to make this accessible information that works. So the 6Ns was something we came up with because a lot of people can memorize 6 categories instead of memorizing everything they ever have to do. So the first one on our list today is non-taxed income, because that is cash flow, but it's not in taxable income. So if you think about the 1040, let me give you some examples of non-tax. We've got tax-exempt interest. We've got the untaxed portion of Social Security, of IRAs, of pensions. We have child support received. And for divorces after a certain year, their alimony is also non-tax. We have military pay. We have ministers' housing allowances, and that's not the whole list. So those are all things that doing a 1040 analysis, a lender has to spot and include if they are recurring. So what about the pass-through entities? Well, of that entire list, the one we see most often with the pass-throughs is the tax-exempt interest. We will see it actually on the M1. There's a spot for that. We will see it in the 1040 when it passes through, but we can't tell it's passing through. We just see it sitting there on tax exempt. So that one is a little bit tricky. If we're going to give them credit at the 1040 level for the tax exempt, we don't find it and use it in the entity. Or if we're not going to put it in the 1040, we can use it in the entity. So we have a little double counting challenge, but that's really the most common non-taxed item. The good news is you don't have to count on that being the only one. You go to the M1, find non-taxed income, and it will list anything else that might be non-taxed that we should include in our analysis. M1 is where to go. So that's non-taxed income. Then there's the flip side of that, David, the non-deducted expenses. So what are those? Where are we?
Non-deductible expenses. First of all, the one that stands out is 50% of meals and entertainment. So the IRS only gives us 50% credit on those. Although I spent full dollar for dollar on those, I only get deduct 50% of those.
Nobody's letting me pay half yet, David. I regularly say I only can deduct half. Is it okay if I pay half? Not a single restaurant has gone for that yet. And I ask all the time.
You said, yeah, here's half of the bill here. I can't, because I can only earn it out off the other half of it. So that's one of them that we have to make an adjustment for. So basically to recognize the other cash went out the door. Principal loan payments kind of makes sense in the sense that that's not a deduction. I mean, it's reducing my outstanding loan balance. So we're not going to deduct that. Now, the interest, we're going to make that deduction in the later portion of it. But we'll look at that. Penalties for underpayment of taxes. Now, you would think I get penalized, I get interest on those penalties. Why shouldn't I get credit for that? Well,
you're bad.
So why should we give you credit for doing something that we didn't like you to do to begin with? So that's the list. The same as really for the pass-through entities, but the location kind of is a little bit different of where we try to find those. Just like non-tax income, we're going to look at the Schedule M1. That's where we find the non-deductible expenses. You will see how we do that, where we adjust from book to tax in the front of it. That's where we're going to look and make those adjustments. So you subtract any of those items, the expense that you have counted that you may be limited on. Now, one area that I would ask you to ignore, and Linda's going to touch, is non-cash. Sometimes we see this depreciation on there, and how does that impact it? Linda, where do we find that?
Yeah, so the deal is that, first of all, what you just told us might have some depreciation in it. So non-deducted expenses include depreciations on the books, but not in the tax return. So there's a different set of rules for book depreciation and tax return. So when I go looking for the non-deducted expenses, I'm only looking for ones that are not non-cash. So they really did spend the money on the meals. They did not spend the money on depreciation. So it is a little bit tricky. The other tricky part about it, David, because there are so many, is that the M1 on the 1120S is slightly different than the M1 on the 1065. So the non-deducted expenses, the non-taxed income, the line number is not the same on the two. So you always have to be looking for what it's called, not trying to memorize a line number to go find it. And actually, the non-taxed income, non-deducted expenses is the lower left, non-taxed income is the upper right. Doesn't matter what the line numbers are. They're in the same visual place on the M1. They just don't have the same line numbers. So more about non-cash, though. A lot of lenders learn that one right out of the get-go. It's like, okay, add back depreciation. I'm not sure they could tell you why they do it, but they know to do it, right? We teach them to do that. Well, it's because depreciation is the bookkeeping write-off over time of asset acquisitions, tangible assets. By the way, amortization, bookkeeping write-off over time of intangible assets. Depletion, bookkeeping write-off over time of natural resources. So deplete coal, deplete timber, etc. All of those, though, are ways to write something off over time that are not cash. And actually, it's even kind of worse than that. In financial statements, depreciation is designed to be used, matching the life of that item. So no matter how we paid for it, we're trying to show the use of that item over time. Not true in tax returns. Tax returns, the depreciation method we pick it is usually the one that will depreciate quickest because we're trying to defer taxes. We don't care about it matching anything. We want to take the depreciation deduction as quickly as possible. If we can take it all in the first year, we would do it. And that is why there's a difference between depreciation on a tax return and depreciation in a financial statement. Well, so on a 1040, let's see, what else do I have that is non-cash expenses? Well, we do have net operating losses. We also have non-cash income or non-cash income items sometimes, like IRA rollovers. They look like there's income there, but all they did was take it from one place and put it somewhere else. So we do want to be sure that we don't count non-cash income for them, and we don't count non-cash expenses against them, which is why your software probably adds back depreciation and also amortization, depletion if they put it in the right place. And it's why we teach people not to use those NOLs or any carryover on any schedule anywhere in the return. So if it's a capital loss carryover, not using it. If it's a passive loss carryover, not using it. And really in our class, except for NOLs that doesn't use the word carryover in the name, we just say, if the word carryover is in the name of that thing, don't count it. And how do you not count something? Well, if it's already in the bottom line, you got to add it back, declare it. If on the other hand, like a bunch of our ag lenders, you're actually listing all the expenses into your worksheet, then you just have to skip that one. So it just depends on whether it's in your numbers yet. Now, NOLs brings me, though, to a complication. I think people watching these live streams are getting used to Linda's complications, aren't they? It's never totally straightforward. Here's the thing about NOLs. And this is one, again, I think your experienced lenders may be missing this. NOLs, no matter how large they are carryovers from prior periods. The problem was last year. The problem was 3 years ago. The problem was 7 years ago. So it's totally appropriate not to count the NOLs against us current cash flow when we see them. That's fine. I think most people are doing that right. But NOLs also reduce federal income taxes. In fact, NOLs are turning other income into non-taxed income by wiping out some of it. So the question I have for you is, what if they just used up a large net operating loss? Well, then the federal taxes they have this year are based on a deduction that is going away, a non-recurring deduction. How can you tell? Well, you can look at on any schedule where any tax return where they have an NOL, there will be a schedule in the back of the return somewhere that shows what year the NOL came from, how much has been used up, and what is left. So we train lenders, if it's a large NOL, to at least go back and look at that schedule. If it's completely used up, then we train them how to estimate what the tax increase is going to be now that it is gone. And this only applies if in your process you do subtract federal taxes. Now, mortgage lenders don't. There's others that don't. They do a different debt to income ratio. But if you use debt coverage ratio and you subtract federal taxes in determining what's available to pay debt and to pay the owners, then if those taxes are going to change because a major deduction is disappearing, it would be wise to notice it. So I think we do a pretty good job of teaching people don't count the NOL against them. I'm not sure we do as good of a job of asking them to please take a quick look and make sure it's not gone. And the other thing I'll have business owners do, actually, business lenders rather, is go back and see if that NOL is like every other year, it's all over the place. In other words, is this a really volatile company that has a huge loss every third year? Or was it a one loss quite a while ago and it really doesn't factor into my concern or my risk factors at this point? Let me check my notes here because admittedly I just went on and on about that, but I think it's a good example of how we teach part of it, but sometimes don't teach kind of the rest of it. What if? What if? All right, so I do think we just covered the three ends that get us to historical cash flow, only half of the story, because now we got to get from historical to projected, and we will have another live stream on that topic. David, anything to add to this one?
Well, we'll cover the next three ends for when we're talking about projected cash flow. But I think we covered a great deal of it as well. So that's kind of it. Very important conversation talking about some confusing issues, hopefully provided some clarity there on our K-1 and pass-through series. It's always filled with conversations between Linda and I and some interesting stories, Linda, interesting stories. But I think it's helpful for our lenders as they get through these, kind of when they encounter some issues when they're dealing with underwriting pass-throughs.
David, I'm wondering, so should I do a live stream on the 92nd bank that failed in 2009?
I think it would be interesting for all of us.
It could be. Okay. So those of you who are out there, if you want to hear that story, use what David's going to share with you next to ask the question.
Share us your comments, ask us our questions, or put something out there to say, you know what, Linda, I want to hear more about that bank that failed. Reach out to experts at Lenders Online Training. And if you want to find out more, you can actually check out our website at lendersonlinetraining.com/ask the experts. And we will put your question in there and we will respond either part of maybe a live stream that we do, or we'll answer back in that email because we're very appreciative of your questions and very responsive with answers. So I want to thank you all for coming. Until next time, have a wonderful day. Bye now.
Bye.